There is a question here. A company uses straight line depreciation for both tax and financial reporting purposes. The following data relate to machine number 108, which costs 400,000 and is being written off over a 5-year life. Then we have three columns. The first one is for years 1 to 5. What is the amount of operating income? Then we have savings in cash, operating costs. See, when this is the information, what is the data, what is the information which has to be taken into consideration is what we have to look. The other details are all of these amounts are on a before tax basis. So the operating income is before tax, and the tax rate is 40%. The company strives for a 12% rate of return, and we are asked to calculate traditional payback period. Now, how do we start? When we have this set of data, operating income is given to us, as well as what is savings in cash operating costs. The operating income is after considering the revenues as well as the costs. See, costs are all considered and they have arrived at what is the operating income. So this set of income as of now becomes irrelevant. We do not consider, because if this was only the revenue part of it is, or anything else, so save only savings in cash operating costs are given, so maybe we would start with that. But then finally the operating income is already calculated and provided to us, so we don't have to take the third column at all, so that becomes irrelevant. Then there is also mentioned that this operating income is on before the tax amount is not paid. Then tax rate is given as 40%, and the company strives for a 12% rate of return. Now, before we come to 12% rate of return, what we understand here is the profits are provided to us. That is also profit before tax is provided to us. See, there are 5 capital budgeting techniques. Out of these 5 techniques, only one technique, which is ARR, uses profit after tax. All the other 4 techniques use cash flow after tax to take up the calculations and infer whether the project should be accepted or rejected. So the base is cash flow after tax, not profit before tax or profit after tax. So we need to arrive at what is cash flow after tax. Cash flow after tax is profit after tax plus depreciation. So step number 1, what do? We have to first calculate what is depreciation amount. Since the depreciation is on a straight line basis spread over a period of 5 years, so we have the depreciation calculated as 400,000 divided by 5, which is equal to 80,000. Done. So let's start writing the details. We also have another important information, which is the cost of capital, or the rate of return is 12%. 12% rate of return is also as of now irrelevant for us, because payback period, that too traditional payback period, does not discount cash flows. So only when cash flows are discounted, rate of return of 12% will become applicable. But right now, since it is traditional payback period, we do not have to discount the cash flows. Therefore 12% is also irrelevant for us as of now. Now, after the calculation of depreciation, now for us, we have to arrive at what is cash flow after tax. Cash flow after tax is equal to profit after tax plus depreciation. Now, 5 years data is given to us. 5 years data. So should we write all these 5 years data in the column? Let's use, little wisely. When we look at the options which are given, we understand that the payback period is anything between 2nd year and 3rd year, or max it would be between 3rd year and 4th year. So in that case, let's only write till 3 years first, test it out if it is fine. If it doesn't match with any of these 3 options, then we can include 1 more year. So otherwise there would be a lot of time wasted. See, if we write the operating income for all 5 years, column by column, if we are doing, it would be lot of time taking process, which may be irrelevant also um, of the data which is included for the fourth and fifth year. So let's do it wisely, because from the answers, we see that the answer would be either between the second and third year, because it's 2 point something, or max it would be between the third year and fourth year, because one option is 3.4. So as of now, I am writing only for 3 years. Write the operating income for 3 years, and to find out what is profit after tax, profit before tax into 1 minus tax rate. We know the equation. So just calculate 150,000 into zero point 0.6, 200,000 into 0.6, 225,000 into 0.6. We already know what is the amount of depreciation, 80,000. So write the depreciation amount, add back depreciation to profit after tax to find out what is cash flow after tax. Done. After, now the base is cash flow after tax. What is the concept of payback period? Payback period is the period in which the investment amount is paid back. What's the amount of investment? 400,000. Now, when would this 400,000 exactly be paid back is what we are to find out. The cash flows are not even, they are uneven. That also we can see. So what we do is, in the next column, we have it as cumulative cash flow after tax. So we keep on accumulating what are the cash flows. The first one is 100. By the end of the first year, we see that by the end of the first year, the cumulative cash flow after tax is 170,000. When the next year's cash flow is also considered, so we see that 170 plus 200,000 becomes 370,000. So 370,000, we want 400,000 to be paid back. So add the next year's cash flow also. So when we add the next year's cash flow, it is 585,000. So the amount of 400,000 is paid back between the second and the third year. So that much we understand. By the end of second year, 370 was paid back. By the end of third year, it is more than 400,000. So anything between second and third year. So how to find out? Let's write the equation. See, a major portion of the investment, 370,000, was paid back in 2 years. So 2 years plus how much more should be paid back? That is 30. That is 400,000 minus 370,000 is 30. 30 is to be taken from the next year's cash flow. See, next year's cash flow is 215,000. So logically, if we talk about, see, 215,000 was paid in 1 year's time period. See, for us to write the equation, let's just look at the logic. So 215,000 was paid in a period of 1 year. So we want only that fraction of the year between second and third year. So the fraction of the year wherein 30,000 was paid back. So 30,000 is requires what portion or what fraction of the year. So we write the equation 30,000. The fraction would be 30,000 by 215,000, which is equal to 0.1395. So the time period is 2.14 years rounded off. So the answer is A, 2.14 years. I hope it's clear.